Hello friends and welcome back to my channel. And in today's video we are going to discuss the most important question that is haunting the Indian investor is, are the markets going to crash? Now before we proceed, I wish you all a very happy and a prosperous Diwali, and may Ma Lakshmi bless you with all the wealth that you need to fulfill all your financial goals. Now, in this video, we are going to discuss 4 major pointers which will help us in analyzing the current situation of the markets. First, are the markets expensive? Second, what exactly is happening now? What is the economic space? What is the GDP growth? What is happening with the financial savings, etc. Third, what as an investor we should be doing? And last, we will understand whether the markets are going to really crash or it's just going on because the markets have moved up and it's just moving around, that market is going to crash and things like that. Let us begin. As an investor into equities, we need to understand one thing, that markets correlate with profit growth over decades. Now, what if past returns have exceeded profit growth? Let us see. From 1992 till 2002, Sensex grew 1.3x, but nominal GDP grew 3.8x. This is because in the preceding decade, that is from 1982 till 1992, Sensex delivered 11x returns and nominal GDP grew just mere of 3.8x. But interestingly, from 1982 till 2002, Sensex grew 14x, whereas nominal GDP grew 13x. This comes to us that over decades, Sensex and GDP growth correlates well and it goes hand in hand. Currently, what is happening? Currently, we see FIIs are selling, and FIIs have sold around 1 lakh crores of Indian equities. Now, where they have invested, we will discuss. But the DIIs have also supported the markets by infusing similar or roughly 1,05,000 crores into equities. Now, why this has been happening? We see that in last 3-4 years, financialization of savings is happening. SIPs are at all-time high of around 24,500 crores. Net, if we catch, it is around 15,000 to 16,000 crores of inflows into equities. Secondly, EPFO is also investing into Indian investors. They invest in ETFs, but they are investing into equities. So, roughly around from 1st April till October, EPFO has infused around 27,000 crores into equities. If we say that this is the trend that is going to be by April, nearly another 27,000 crores, which adds on to around 54,000 crores into equities. So roughly 1,80,000 crores of SIP inflows plus around 54,000 crores of EPFO money. I am not adding what NPS is going to pump in. I am not adding what retail investors like you and me is going to pump in. I'm not going to add the lump sum flows. These are the planned flows that are coming into equities which have supported. Or else imagine what would have happened if FIIs were withdrawing and there were no domestic flows, then markets wouldn't have been crashing around 6 to 7% what we see today. It would have been a 30-40% crash. Does that mean that just FII withdrawals will not get us returns? Let us see. From 21st January 2021 till January 2023, 27,000 crores have been withdrawn. But Nifty returns have been positively 18% plus. So this we cannot generalize and say since because FIIs are moving out, the markets are going to crash. See, second reason why FIIs are withdrawing is China has given stimulus to boost its economy. Around 1.4 trillion debt stimulus is being issued in China. That is their internal matter why they have issued. Basically to support the economy, that is what they have done. They have cut down rates and a lot of other stimulus measures they have done. But that is not the only reason. FIIs are also investing in Japan. It's not that they have gone to China. In Japan, they have invested around 12, 12, 12 billion USD in the same time frame. Plus, they've invested in Taiwan, they've invested in Korea. India is not the only market where they have withdrawn. They have withdrawn from Malaysia, Thailand, Russia, Brazil. They have withdrawn from all these markets, and they have gone to China. Now, what can happen? China can give further stimulus. The reason being, there is US election. There is pressure on Chinese market that is built up because of US elections. The reason being, if Trump comes to power, there can be further sanctions on the Chinese economy. See, Trump is pro-US. Let us understand. So he can give sanctions on other emerging markets, and he can put sanctions on India as well. There can be good diplomatic relations, but there can be economic impact on Indian markets. So these are some points what are putting pressure on Indian equities. Further on, we have seen that Q2 results are also not that great. Now this is because we have seen erratic monsoons. Also, we saw elections in the first half of the fiscal year 25. Also, what we can see is government intends to do capex spending of around 11.1 lakh crores, out of which they were able to spend around 37% only till date in the first half. Whereas this figure during the same time last year was around 49%. This is because of the same reasons like the elections or monsoons, we may say. Even fiscal deficit is not gone up. It is just 29% of the total expense. Whereas it was 39% in the last year YOY basis. Now one would say that look, fiscal deficit has not gone up. It's a good sign. But this is because the capex that the government has not taken capex because the government is not able to do in as vis-a-vis last financial year. Now, uncertainty over the US elections. What is happening in US currently? If Kamala Harris comes up, there can be continuity in the policies. If Trump comes out, as we discussed, there can be sanctions that are going to come up on China, on other countries maybe. Because he is pro-US, he says US first. Secondly, what we see in US is the current yield, what we saw on 1st of September, US GSEC yield is around 3.78%. It's very high. Spending can be aggressive there, and if Trump comes to power, their debt can rise to 7 trillion over the next 4 years. Now, Fed had expected GDP growth of around 1.78%, whereas that figure, they call it flash GDP numbers. That flash GDP number is around 2.87%, 1% higher than what was expected by Fed. This is in line with what the economists were expecting. But see, if there is GDP growth in US, that means there is going to be lesser reduction in rates, lesser stimulus packages that are going to be given by the US government to the US corporations. So, stronger US economy is putting pressure on US equities as well as the equities around the globe. So these are some of the factors which are being played out in last couple of months, and now it is the peak that we are going to have the results of US elections, etc. in near time to come. Now the main question, having said all this, are the markets going to crash? I'll talk about a story which I came across in one of my readings. See, it is said that in Mayan mythology, the world was destroyed 4 times. First, people stayed in the Rocky Mountains. So there was an earthquake and their habitat was destroyed. So Survivors of the earthquake went on to the plains. This time they were prepared for the earthquake, but there were floods and their colonies were destroyed again. Again, the survivors of these floods went on to the woods and stayed in the forest. What happened? There was a fire, and again their colony was destroyed. This time they were prepared for the earthquake as well as they were prepared for the floods, but they were not prepared for the fire. Now this is what I call something penultimate preparedness. They are prepared for the last worst thing that has happened. Now fourth time why the world was not destroyed, sorry, I can't recall. Maybe it was a recession, or maybe it was some pandemic or something like that, but I can't recall. But this is something called as penultimate preparedness. We are prepared for the last worst thing that has happened. So for example, today we are prepared for COVID. A few years ago we were not aware what is COVID, but today we are prepared for COVID. We are prepared for a financial crisis that can come, but it can come in a different way, but similar to what happened in 2008 we might not see in future. We are equipped to take care of ourselves of the financial scams which happened in India in 92, in 2001, but something else can come up. So whether exactly there is going to be a crash in equities, nobody can predict. Just because FIIs are withdrawing money and going to some other markets does not mean that the Indian economy is weaker. Indian economy in the last few years was leverage driven, and there was consumption growth and things were working fine. Today we are at a stage that हमारा पेट भरा हुआ है, and that can be a chance for the FIIs to book some profits and move on to greener pastures. This is what is happening on the FII account. Also, the answer to the straightforward questions about crash is not that easy, because equities are valued over future earnings over decades. It's not like some goods or services whose value we can just ascertain, like a software, like a service. It cannot be ascertained on day one or tomorrow. It's over decades to come. So what a common investor should do: stay invested, stay calm and stay put. If you are a stock picker or buying direct equities, buy some quality stocks. Or if you already have a portfolio and you have quality stocks in your portfolio, buy them. Do not trade. Trading in today's scenario, or rather buying some punter stocks, like punter means that buy today, sell tomorrow, or for a short period of time, 6 months, 1 year. It's like in a correcting market is like catching a falling knife. You never know how it will hurt you and how badly it will hurt you. So we need to make a certain decisions that are going to last over time. If you are an investor not directly into equities, come to mutual funds. And if you are already investing in mutual funds, you are at the right place. Invest money, average out. This today's averaging out is going to give additional kicker to your returns, and your systematic approach will go long way in making a defined corpus, as well as it's going to help you out in accumulating more units in this falling market. So be a disciplined investor. Just because somebody is telling that market is going to fall, it's not going to happen. It's like, oh, that person, वो आदमी भगवान से मिला होगा. If somebody knows that the market is going to crash, or these are not very straightforward answers. So as a person who has interest into equities, I would suggest that you invest with a long horizon. Invest with a financial goal in mind, say building a corpus for your retirement or building a corpus for anything 10 years, 20 years down the line, stay disciplined, do what you are doing, and have faith into Indian equities. We have seen many scams and many such things. These kind of things are going to come and go, like consumption slow down, corporate profits going down, FII withdrawal, US elections will come and go, but Indian equities are resilient and it's a long way to go for us. So friends, I wish you all that in future you don't invest in equities for gains. I wish that you invest in equities to create enormous wealth for you and the family, and this in turn will help us to grow the Indian economy to the desired levels what we want to see in future. Thank you so much. If you have any questions, doubts or queries, please do not forget to leave them in the comment section of this video. This will help me in understanding what goes around in the minds of people, as well as I would be able to better address your queries in near future. Thank you.